Hey, well, thank you. This is Greg Herlean, and glad you're all on the call here today. I want to just go over kind of quickly on the things I'm going to talk about. Appreciate you taking the time today, and I also know this is something that will really change the way you think about money. And specifically, some things that you're going to discover: how to make more money and not pay taxes. Maybe not at all, or a lot less than what you're currently paying. Also, going to teach you how to use other people's money. For those of you on the call that might not have enough money to do certain deals or opportunities, I'm going to teach you how to use other people's money. Obviously, as well as how to create a legacy for you and your family and to maximize your returns and diversify like a lot of the wealth you're doing. And also, I'm going to teach you a strategy at the end that is a strategy in which I use all of the time. It's super passive and which actually allows me to work on my why, on my freedom to be more with my family. So anyways, I appreciate you being on the call. I've got a gift for everyone here at the end of this webinar as well, for everyone that's going to be on this call. So I know it'll be worth your while. There's a couple of parts that you might have heard before that you think you might know all about, but I assure you don't. I've had the opportunity to not only invest and be in the investing world for my whole career, I've also been able to see literally what tens of thousands of different individuals have done as far as investing goes, because they're all underneath the house of a company of mine. So I'm able to see where people are having success, where people are failing, what the ups and downs, how to eliminate those ups and downs. So I assure you, my experience and what I'm able to see on a daily basis will give you great insight on where to go and actually how to have success. So real quickly about me, I don't want to spend much time on this, but give you a little background on myself. I am the CEO and the owner of Horizon Trust Company, which I'm going to talk about here in the beginning of my presentation, which is an IRA custodian company. I've been over 15 years now of funding different businesses and real estate. I've lent over $1 billion actually in real estate over my career. I'm a very active investor. Wrote two books. One is called Bank on This, and the other called is Flip, Bank, Live. And I spend a lot of space in the IRA retirement plans as well as real estate. That's really my focus. So again, I already said these few things at $1 billion. Last bullet point, I think, is probably the most important in my why. This crew right here, the wife and 4 kids. We really work hard, and I did catch Cash here. That was my little guy in the air there, my little Cash. That's his name. There's Carson, my oldest, Miley, Cole, and then Cash. So let's jump right into this. I'm going to go over a couple stats here first, because I think these stats are important for you to understand. To really understand why this message I have for you is so important. So the Social Security Administration did a survey on income and for retirees at the age of 65. The stats are this: at the age of 65, only 1 is wealthy and 4 are financially secure out of 100 people that are retiring at age 65. That's a huge problem. And what's furthermore interesting, what financially secure means is that an individual has at least $3,500 a month coming in. $3,500. To me, that isn't financially secure. This is the problem with today in America: is we are not prepared for retirement. How do we get prepared for retirement? I'm going to go over that, and you will learn 2 different strategies today that will completely change the way you're hopefully investing in a way in which you'll make 1, 2, 3, 4, maybe 10% a year more on your money, which can trim off 10 or 20 years, frankly, of you having to work if you just start working a little bit smarter. So let me jump into it. Things that we want to avoid, obviously, is inflation, going broke slowly. I mean, how many people are so excited when they go to their banks? The banker's like, oh, I'm going to give you 0.2% or 0.5% on your money. It's kind of a joke, frankly. If you leave your money at the bank, you are going broke slowly. You will outperform your money for sure. Volatility. How do we avoid the volatility of the stock market? That's another enemy that could happen. Imagine if you were retiring in 2008 or 99, or when the market, maybe in a year where it crashed, and you were saving all your money, but that was a year that the market was way down. You have to eliminate or really bring down that liability of how much volatility is in your portfolio. If you're going to retire soon or look to retire soon, you cannot be in a volatile market with all of your money. So we got to avoid that. Number 3, we'll talk about this a little bit more in detail, but we also have to avoid paying too much in taxes. How do we avoid paying taxes altogether, or at least avoid paying most of the taxes? Those are the 3 enemies, frankly, when investing. Inflation, big one, volatility, and taxes. How do we avoid those three things? I'm going to teach you how I've seen that. This is one way in which you can avoid those three things. And I'm really focusing on really two of those things is the self-directed IRA. Some people think they've heard all about the subject. You absolutely have not. I've been doing this long enough that there's a few things that will totally change the way you use a self-directed IRA. So for those of you who have not, don't know what it is, a self-directed IRA is basically a descriptive and not a legal term. It basically is an IRA in which allows you to invest in what you want and choose. Unlike your traditional brokerage account, wherever that may be, Fidelity, Charles Schwab, Chase, wherever you might invest, TIAA-CREF, that in those places you get to not choose. You basically get to choose from a menu of different investment options they have that they get paid on. When you have a self-directed IRA, you can invest in those things, but also almost anything else. We'll talk about the things that you can't invest in, but it's very, very small list. And by the way, a self-directed IRA has been around for over 30 years, actually over 40 years now. And so this is not a new concept. The wealthy are doing it. Many of the wealthy are doing it, and you'll see that. But you can have a traditional IRA and convert it to a self-directed traditional. You can have a Roth and convert it as well, or an old 401k and also have it as a self-directed account. This is a big deal. This is something that will change the way you invest. It will save you money on fees. And if you just save money on fees alone, that extra 1% or 2% you save in fees, which you probably think you're not paying, because I assure you most you are, in loads and debt fees and loads, different stock brokerage fees. A lot of people aren't aware they're paying these loads and mutual fund fees that, oh no, my financial advisor, I don't pay that to him. Well, you are. And so no matter if the market goes up or if the market goes down, you're getting paid that. And so, or you are paying that. So just by self-directing, you can eliminate fees. And that extra 1% per year over a long period of time of compounding can make a big difference in your account. So let's talk about self-directing a little bit more. First of all, an interesting statistic is there's only 4% of IRA accounts are self-directed. 4%. So there's over 80 million IRAs in the United States, and that represents over $4.8 trillion, and only 4% of it is self-directed. Why might that be? Why do you think there's only 4%? The big answer, there's two, but really the biggest answer is for your financial advisors don't want you doing it. Once you move your money into a self-directed custodian company, they do not make fees on that money. So they are not going to teach you and educate you about it. That's one. Another reason why you might not know about it is you might not have enough money. A lot of people think they have to have too much money to actually self-direct. That is not the case. You can start, open up an account with very little money. A lot of our clients will open up a new self-directed account with $4,000, $5,000, $6,000, and so that is a myth, and that is not true. Most people have not heard of this because their advisor has not told them. So, what else? What is a custodian? When I say that I am a CEO of Horizon Trust, it is a custodian. What does that mean? We are a licensed and bonded FDIC insured company, which means when your money, if you move it over from XYZ company and you move it over to Horizon Trust to hold it, first of all, that is a tax-free transfer. So it transfers over, so you don't pay any penalties or taxes. And then number two, when the money sits with us, it's actually insured up to $250,000 as long as it sits with us. Now, once you self-direct it, meaning once you invest it, which we'll talk about in a second, and move the money out from us into your investments of your choice, it's obviously not insured then. That is when you start taking risks of the different investments you're investing in, and we'll talk about that here in a minute. Also, it is regulated. We are regulated by the banking industry, and so we get an audit every single year from the financial banking industry, and we get audited every single year. So we are. This is not a fly-by-night kind of shop. This is something that's been around for a long time. Horizon's been around for over 5 years. It's got thousands of clients, and really we focus on the customer service experience and making sure everything is done accurately. So, how do you get into that 4% club? We talked about in the beginning, out of every 100 people that retire, 4% are financially secure. What does that mean? How do you get in that club? Well, those people are typically generating bigger returns, and they've also reduced the volatility, and they have eliminated the taxes almost altogether. And so we're going to talk about that. And as we do so, in creating that wealth and protection up here as far as getting bigger returns, we're going to talk about how to create those profits and protect your money and to continue to prosper. And so let me tell you about my first experience with a self-directed IRA. My first experience with a self-directed IRA was actually I was doing a real estate condo conversion, actually rehab. And you can see this is a good picture of one of the first deals that was done that I did. I actually had somebody invest in me, and they actually lent me from their IRA, their self-directed IRA, the money to purchase this unit right here that you're looking at and rehab it and sell it. This individual lent me $60,000. After I had rehabbed it over a 3-month period and sold it, he got back 75% of the profits. That was my agreement with him. The nice thing about a self-directed IRA is you can actually call the terms, and as long as you both agree, then you write it up. And so he lent me 100% of the financing I needed. I gave him 75% of the profits. His IRA lent the money, so $60,000 came in to purchase this property and rehab it, and then it sold, and he got a $12,000 check back to his IRA. So he got a 20% return on his money in 3 months, which is more like an 80% annual return. All that, and he paid no taxes on those gains because he did it with inside of his self-directed IRA. That is an example of someone who is investing in a non-traditional asset with an IRA, but number two, an example of a deal in which I did with no money out of pocket. I ended up making $4,000 over that 3-month period on that one deal. Good example. Now this one I always like to show because it was one of the properties we did. It's just kind of funny. It was also done with an IRA, but people get all excited like, man, you could have made all this money in recycling. The bigger question and you should be asking is, why was I not invited to that party? That is my joke, and so hopefully one of you is at least laughing, but that is the joke of this webinar. So IRS has been around for a long time. The IRS, you can go to the Department of Treasury and see self-directed IRA has been around a long time, and here are the restrictions. You can invest in almost anything with the exception of collectibles, insurance products, and real estate products that you are personally using. You can't use your IRA to buy your personal property or to purchase an investment property. So moving along here, let me give an example of an individual who's using a self-directed IRA and of how I'm describing here. An example here is Tim Banks. We'll use him as a 40-year-old. He's 25 years away from retirement. He's got $45,000 in his Roth IRA. He wants to actively flip homes, let's say, trade stocks, buy businesses. Let's just say he wants to do something non-traditional. And so what does he do? He could be doing that. Many of you are already doing these different investments and opportunities and businesses outside of your IRA, just like Tim was in this example. Let's say Tim now does these things inside of his Roth IRA rather than just doing it outside of his IRA on the left-hand side. The left-hand side shows an individual with $45,000 making 17% of his money over a 20-year period at a tax rate of 30%. His balance in that account would be $426,000. Or doing it inside the Roth with that same $45,000 at 17% rate of return over a 20-year period, no tax rate. Look at the compounding difference. Over $1 million is what that balance is at, which is a $600,000 savings, tax savings. So this was not any kind of interest rate being any better than the other. Time was the same period. This was all a difference of him doing it inside of his Roth IRA rather than outside of his IRA. I implore and I ask you that if you're doing certain things, you don't need the money now, do it inside your retirement account. And do not wait. So many individuals that I meet are like, you know what, I'm going to start my IRA once I pay off my credit card or pay off my house or have a baby or whatever the case is. Don't wait. I assure you, you'll be disappointed. The stats show that the average 50-year-old at retirement, as far as in the retirement account, has less than $50,000 in their retirement account. Less than. At 50. Now, some of you might be in that boat, but it is not too late. If you're in that boat where you're 10 or 20 years away from retirement and you start doing some of these things inside of your self-directed IRA, you can be way better prepared and be part of that 4% financially secure. I assure you of that. So let's talk about some of the things that people say about IRAs. I make too much money to contribute to a Roth. That's actually inaccurate. There's a opportunity and then vehicle within inside of a 401k that we can help set up, where you can open up a self-directed 401k with us at Horizon Trust and open up and create a Roth bucket underneath that. We can help you with that, and we actually will hold your hand through that process and teach you how to do that. So Even somebody who makes $200,000, $300,000, $400,000 a year, they also can have a Roth as long as it's set up through a self-directed 401k. Also, can only make $50,000 per year. In that example of the 401k setup, you can actually put away up to $56,000. $56,000 per year into a Roth. That's been unheard of. People only think they can put up $5,500 or $6,500. That is not the case. You absolutely can do this if you are one of those individuals that make more money or have more money. There's just different steps in doing it. Of course, the IRS has created rules through the government that allows those that make more money to do special things like this. And really, it's just a lack of education that the American people don't have. It's been around for a long, long time. So, I can only make $5,000 per year. You do not limit yourself on how much you make. And that example I gave you of my client back then who lent me the $60,000, they lent it to me, made $12,000 in a 3-month period. Therefore, that's $5,000. If that was the rule on $5,000, then they couldn't have made $12,000. But they did, and they can. You can make as much money as possible inside the Roth, and you need to. That's obviously the point, is making as much money as possible. I love, love, love the Roth IRA. A lot of discussion. I only bring this up because a lot of discussion came about these Roth and these different IRAs because of back when Romney ran, how big his IRA. He went from $21 million to $102 million. That's because he was investing in things that he understood and he was a part of. You too can invest in things that you understand and that you're passionate about as well. There's only those few prohibited transactions. Here's a couple examples of things people are investing in. Single-family homes, apartments, duplexes, stocks, land, different real estate wholesaling options. These are great ways of creating great profits, tax-free, with inside your self-directed IRA. So, an individual, here at the age of 38, starting with $50,000, there's a big difference between you investing it inside a traditional IRA and a Roth IRA. The Roth IRA, you'll amass over that 30-year period, more or less, about $2 million. If you do it inside a traditional IRA, it's a little bit less because you're paying more taxes up front, so you're putting less money in along the way. Let me give you an example. It's $1.9 million. I'm sorry. That's not the example. The example is this. If you were to take that same $50,000 and do it over 30 years outside of your IRA, the difference is $1.9 million. You'd have way, way less money if you're doing these different investments inside of your IRA or outside of your IRA. One other thing that's interesting as well is the 401k. You can open up a self-directed 401k, and by doing so, you can have bigger contribution limits, but you also can borrow money. In a 401k, I've just seen a lot of individuals that have an IRA and they wanted to borrow some money, and so you can't do that. So what do? They actually take out money and pay the penalty. They take the penalty, the taxes and penalty, and then after they take that penalty, they borrow that money and do whatever they want with it, but they've had to pay all those penalties. You can actually open up a self-directed 401k and borrow against it. 50% or $50,000, whichever is less. If you've got like a $200,000 self-directed 401k, you can borrow up to $50,000. If you have a $50,000 IRA, you can actually borrow up to $25,000 or 50%. This is a great source, a place for individuals to go if they needed something really bad, education or a wedding or a home, a first home, whatever the case is. What's really great about that is you can borrow the money and pay it back within 5 years at prime plus 2. So if you pay yourself back, you're actually paying back your retirement account. And when you do so, the interest that you're paying yourself. That interest stays inside of your retirement account. So it's kind of like a 0% loan when you borrow your own money from a retirement account. This is critical for those individuals that are looking to borrow money, need money for some kind of emergency or something coming up. So, who can do this individual 401k? Anyone who has intent to make money, who has a business. There's so many different case scenarios. We will teach you and help you for those individuals that are looking to borrow money against their 401k. Using other people's money in an IRA, I'm going to just quickly go over this. The example I gave you in the beginning, I did that. The reason why that's important is So many individuals I see try to go to banks, and they go to banks for obviously getting money, but banks typically take months and months before they approve you, and then they might not even approve you. The nice thing about an IRA, that someone who has one, if you could teach them and they want to self-direct their funds, it doesn't require any credit check. It's fast, it's easy. You can move over someone, can move over their IRA monies into a self-directed account within 2 weeks. Once the money arrives there, if you and I have an agreement that says, hey, look, I'm going to give you $50,000 of my IRA, and we put together an agreement, a note, a contract, I can actually lend you the $50,000, and you can pay it back to me based upon those terms. When you pay it back to me, obviously you pay it back to my IRA, the principal plus the interest. But you and I would create the terms. So you're not having to go to a bank where the bank tells you what the terms are. This is one place where I found millions of dollars before I even started a trust company, and how I started businesses, and how I flipped over 450 homes when I was flipping a lot of real estate. People ask me all this as well. Can you invest in the stock market? Absolutely. You can continue to invest in the stock market using your self-directed IRA. Now, protecting your money. This is an important one. Obviously, protecting money. You can make all this money, but then if you're not paying attention and doing it outside of your IRA, it's almost in vain. I could actually make a 7 or 8% rate of return, but do it inside of my self-directed IRA, and you can make a 15% rate of return outside of your IRA while I'm doing it inside my IRA, and I actually would make more money than you because I'm avoiding all of these taxes. It's so critical that when you're making your monies, you're doing it inside of a vehicle like the self-directed IRA. If you do it inside a Roth, it actually all comes out tax-free, gross tax, deferred, and comes out tax-free. You do it inside of a traditional IRA, you don't pay taxes along the way, but you pay taxes when it comes out. So you will protect your money from taxes, and a lot of times the volatility of the market when you invest in the things you understand by opening up a self-directed IRA. Then you put the money in there, and then you identify your investment. It is that simple. Typically, most of my investors know what they're going to invest in. Most of them are real estate based. I would say about 30% are stock market based. But both those places, both real estate and stock, you can do with inside of a self-directed IRA. I'm going to teach you one passive strategy here in a second that a ton of our investors do and they have a lot of success with. So how do you put money in an IRA? You can make a contribution or roll over or transfer the funds. Our two main ways in which people open up an IRA is they move money from somewhere else. So if you currently have an IRA with any big brokerage account, you can move it over tax-free. We actually help you do all that. We do it for you. You can move it over from wherever it's at over into Horizon Trust, and that would be considered either a transfer or a rollover, and you get that money done. Very simple. It takes only a couple weeks. Or if you don't have an IRA account yet, but you want to have one, you can contribute to one. You can open up one from scratch and put your first amount in. You could put in $5,500 or $6,500 and make a contribution, which I definitely recommend if you do not have one yet. And then you can take that approach. I don't know if it's truly a lazy approach, but there is a lot of different approaches in which you can use your IRA money, self-directed, into different other people's businesses. You might have full-time jobs or whatever you might be doing, and you don't have time to be investing in oil and gas or tax liens or different factoring, etc. companies. That's okay. You still can do that, and you can invest in those companies through other individuals and not have to do it from a day-to-day perspective. So, Horizon Trust, we've been doing this for a long time. We've got a staff that's very experienced. My partners and board of directors have been doing this for a long time. We take pride in actually teaching people, educating people on what their options are, and getting people to understand they can put a portion of their money in the retirement accounts in these self-directed accounts. It's not just about listening to your brokers. I can tell you, if I just listened to my broker, I'd be much broker. No one cares more about your money than you do. And if you can actually make an extra couple percentage more, invest in things you understand, it will make a world of difference. So it's super easy. You really just need to pick which IRA is right for you. Do you want a tax-free income for the rest of your life, or do you want a tax deduction today? For those of you who want a tax deduction today, that means you're going to do a traditional IRA. It means you're going to pay taxes right now up front. You're going to get a write-off right now for a tax deduction. If you want a write-off right now, that's great. Then you can lower your taxes right now, but then when your money comes out, when you go to retire, you'll pay taxes on the gains. And so there's that approach, or you can do the Roth approach, which is typically a better if you can do that, or convert it, which is you pay taxes today, and then later when it grows, you can pull it all out tax-free. It's a big difference. So obviously the traditional is you get to get a write-off today for any monies you put in, but you have to pay taxes on all of it when it comes out, or you can pay taxes today. So you pay it right now on the seed and of your crop, basically then on the crop, and then it grows tax-free and comes out tax-free. It's really for you to decide. Once you open up that account, you can then fund it with money, and then you can start investing and prospering for sure. So it makes a huge difference. I've seen so many individuals really take control of their account and make that couple extra percentage change. By doing so, your account over this period of time of putting away very, very little bit of money, your minimum contribution, you will have amassed millions of dollars doing it inside of your Roth IRA, rather than outside where it would be less than half of this amount if you did it outside. So here's the example. If you're doing it outside, of your IRA, of the money you'd make, 1.9 million of it would go to the IRS. 550,000 would stay with you. That's powerful. That's why it's so important for you to do a lot of your investments inside of the IRA. So, changing the subject a little bit here, I'm going to teach you about a strategy in which many different investors are using out there that I've seen using their self-directed IRA. Now, this is a strategy that you can do also not using your self-directed IRA. So if you want to use the strategy outside of your IRA, you're welcome to do so, or you can do it obviously inside as well. I've seen so many do it both ways. Depends if you need income now or if you can defer it. So who has seen this at their bank? I assure you, most of you at your bank has something very similar to this, where the banker's all excited for you to come in and walk in and open up that account for you, and they're like, yeah, you're going to make 0.4% or 0.1% in your money. And then, you leave the bank, you're thinking, man, that's not very good, but I guess I'll take it. And then like 3 months later, you go back and you ask them for a loan. That same bank, you go back and you ask for a loan, and what happens? They're like, yeah, sure, we'll give you a loan. And they give you back your money. Who's the winner of that? Who's the winner when they give you back your own money? The bank is. The bank's the winner there. They basically take in your money and then lend it out back to you at 4.5. When I saw that, I was like, I need to create my own bank. And so years ago, I learned the power of leverage and about being the bank, and also about the risk and liability. I'm going to talk about that here. So, mortgages. When banks do lend on mortgages, what are some things that are really important to them? And so I'm going to teach you a strategy that works for me and for many of those individuals I work with, which is a trust deed or mortgage. Typically, what the parts of a mortgage are this. There's a loan, and let's call it a loan amount of $100,000. There's an interest rate. Let's just say the interest rate's 12%. There's a term. Typically, the terms that when I do my lending, I like to lend anywhere from 12 to 24 months. Then there's collateral. Collateral is typically the asset. What is the asset collateral that protects you, that gives you security? And so a lot of times people talk about like your loan to value. That's a collateral. I've got a loan to value of 50%, let's say. And so a home's worth $200,000. I'm going to lend $100,000. I have a loan to value of 50%. That's my margin of safety. That home is the actual collateral on which I am protected. My money's protected. That is a mortgage. Let me give you an example here. This example here on this piece of property appraised, let's say, for $86,000, and they want to borrow $45,000, and the interest rate is 15%. Let's just call it 12% because it's easier for easier numbers perspective. Would you lend $45,000 in this example for this individual on a property that appraises for $85,000? I would, and the reason why I would is because I've got almost 50% loan to value on there. I'm super protected. I've got great collateral. I got the house, and I'm going to get a check for every single month for $450, which is 1% per month, which is equivalent to 12% a year on $45,000. And if something goes wrong, I end up owning an asset. I have collateral, an asset that I would take over rather than a stock. When a stock loses money, it just goes down, and you're out of luck. You're not getting any rental income when a stock loses money. You just ride up and down with that volatility. This is the kind of stuff that I've been doing. Let me give you an example of Charles and Mary, what they do and how it works. Charles and Mary, 55, 53-year-old, they're 10 years away from retirement. They have $350,000 in their retirement accounts. They're not super experienced in managing their investments, and they do not want an active role. In this picture, let's say they just want to focus on their horses and maybe their job. but they do not want an active role of actually going out and finding properties. But they wanted to get better returns. They were sick and tired of listening to their broker and they're getting the same rate of returns, negative whatever, or 3 or 4 or 5%, but they wanted to beat the market. They wanted to get something more consistent and still be secure. They learned all about being the bank and these trust deeds. So what did they do? Let's talk about it. At $350,000, they decided to put in their annual contributions that they're allowed to do every single year, $13,000 total. They have 10 years left to grow at a 9% interest rate. So I'm not giving you any kind of crazy rate of return, 9%. At 9% over 10 years, that's over $1 million in retirement. $1 million. Just by being a banker. If they kept doing what they were doing, they would have had the same kind of returns. Measly would have been around $600,000. It was a $300,000 or $400,000 difference just by becoming a banker. This 9%, these trust deeds, these banking instruments, are things people are doing and they're fixed rate of returns. You know the rate of return up front, which is what I like. There's so many different investments out there that's like it's an equity investment or a stock. It's up and down. You don't know what you're going to get. These, what I like, I know the collateral up front. I know my margin of safety up front. I also know my rate of return up front. And the monthly interest is paid to my IRA account. This is boring for some individuals, but me, sexy. After flipping over 450 homes and apartment buildings and hotels, I can tell you that typically the winner in almost all those cases is always the banker. The banker gets paid first. So I knew over time that I wanted to be a banker, and so that's what I do and I focus on now. So now when the Joneses go to retire, they have over $1 million in their account. At 9% rate of return, they would get $7,600 a month without even touching the principal. Is that financially secure? $7,600 a month? Well, Social Security would say that's wealthy. That is the power of being a banker. That is the power of getting a fixed rate of return and beating the stock market. Guys, it's a matter of 2%. I always bring this up. If I can help you and teach you how to make 2% more per year, and if that's just by saving fees on your IRA, great. Just by saving fees on your IRAs, that's 2%. Or just by not paying taxes on all that on those gains. Just by those couple things I'm teaching you, or avoiding the volatility and putting you in a position where you're a banker. Doing one of those 3 things will change the way you invest. It's the difference between you having $500,000 of retirement or $1 million of retirement. Just by tweaking a little bit what you're doing, just by paying attention. This requires you taking a half an hour a month. A half an hour. That's it. Take control of your retirement accounts. Become a banker. Use your funds in a self-directed account. It will change the way you invest. Become that banker. What I want to do is I'm going to give you I'm going to answer some questions here. I've a few questions that have come in. I'm going to answer those here at the end. But before I do so, I want to end with a couple more slides here that I think are super important for you to understand. It's so important that you have the education and knowledge that you need. As you have that knowledge and information, that's obviously powerful. You go out and now got to go do it, take action. You'll have more time and more money, and you'll do less work as you understand these principles. I'm going to give you some tools that are going to do that for you. And that's what I'm going to give you right here. I'm going to give you my free, I'm giving it to you free, my one-on-one consultation with one of my wealth specialists, people that I spend every day with. They'll teach you and apply these principles to your scenario. There's so many different individuals that have different accounts and different circumstances of when they're going to retire and how they're going to retire, what kind of IRA they have, a simple, a SEP, how you self-directed. I'm going to give you a one-on-one hour session with my people. It's going to teach you. This is a gift. All you got to do is call in. I'm going to give you the number here right at the end, but you're going to call in or go to this link, and we will set an appointment and meet with you and teach you. I'm also going to give everyone this call a self-directed, self-made success get started guide. Yes, that was a mouthful. I'm going to give you that guide as well as my book called Bank on This. And I'm also going to waive your setup fee. If any of you decide to choose to open up a self-directed IRA account in the next week, just for the next week, I am going to waive your setup fee. If I waive that setup fee, then therefore all you're paying, which leads me to one of the questions someone asked, is your annual fee. The annual fee to open up an IRA account at Horizon Trust is anywhere from 70 basis points to 25 basis points. What is basis points? Basically, 100 basis points is 1%. So what I'm telling you is Horizon Trust Company, their annual fee is less than 1%. So if you have a $50,000 IRA, you're going to spend around $300 or $350 per year for us to hold your account and report it to the IRS on an annual basis. This is less, I assure you, less than what you're paying right now. So I'm going to waive your setup fee, which is a few $100s that we charge for a setup fee. I'm going to waive that for you, as well as that will be a gift to you as well. And so again, go to this, go to this link, and also our phone number here. Give us a call. We'll call you back. We'll set an appointment. Everyone that inquires here, I'm going to email you all these gifts and get you this one-on-one session with our team. And so I made it quick and short to talk about these two subjects, becoming a banker and also this IRA subject. I'm going to answer some of the questions now here. I already answered the question about what does it cost, the cost associated. One other question here is about these trust deeds and banking. What is the risk associated? The risks associated to banking when you're lending is a default or foreclosure. So let's say that I lend $100,000 to you on a property that's worth $200,000. Well, if you stop making payments to me, interest payments on that, I would then put you in default and foreclose on the property and take it back. So now my risk is I have a property, let's say it's only worth $100,000 now. Let's say the market's dropped 50%, because people ask me all the time is, what happens when the market drops again? Okay, let's say it drops 50% again. In that case example, I basically would be into a break even. So I could either sell it, or I could rent it out and take cash flow and take rental income. It's your decision. That's the nice thing about a self-directed IRA. We focus on teaching thousands of individuals on what works, how to get monthly passive income. For me, it's about passive income. That's what we focus on. All right. Next question is about target areas. Where do we look to lend? So my team looks at lending in the Southwest region demographic. We get inquiries all the time for people looking to borrowing monies for these quick short-term flip bridge loans. They typically last 12 months. Sometimes 24 months. So they're short term, they pay monthly. What else? If I am a Canadian, if you're a Canadian, you can't do a self-directed IRA, but you still can, if you're a foreigner and you live in another country, you still can be a banker. You still can lend money and get these monthly checks. I can't tell you how, there's just so many individuals that get these monthly checks and live off them. Some people have them in an IRA, some people have them outside their IRA, but they want to put $100,000 in and just get a monthly check of $700, $800. It's very passive. It's audited every single year. Monthly checks go direct deposit into the account, so it's a very good, clean system. Let's see here. Any other questions that I haven't covered? The risk we talked about, fees we talked about. This gift again is for you. I really appreciate the time. Please inquire. Please look us up. I assure you, it's a matter of a couple percent. You start making a couple percent difference in your portfolio, it will change the way you're retired. I appreciate your time. Look forward to talking to you soon. Thank you.